Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And let's get into today's Q&A episode. And the first question is from Matt, a very thought-provoking question, as they all tend to be. So Matt writes, many congratulations again on your fantastic podcast. It would have to be one of the most valuable contributions to financial literacy of Australia, at least at the slightly more detailed level than Barefoot Investor. So thanks a lot, Matt. It's a wonderful compliment that you've provided me. I like to sort of think about, in fact, I considered making the comparison to Barefoot Investor in my book Investopoly, which obviously the podcast was subsequently named after the book. And I like to think of the work that I do is sort of like Barefoot Investor, but for people with money. I hope that doesn't sound too crude, but Barefoot Investor most of his advice tends aimed at kind of the average Australian, which is not a criticism, of course. How to get out of credit card debt, how to manage cash flow, those sorts of things. My aim is sort of do the same, but with people that have funds to invest, of course. So, but a great compliment, and I really enjoy doing the podcast. I really love the Q&A episodes, answering all the questions. So keep them coming. And I'm glad everyone else, or at least the listeners, enjoy it as well. So I'm going to paraphrase Matt's question rather than just read it out verbatim. Essentially what Matt is asking is, are self-managed super funds more attractive now for lower balances, given that the space is becoming more competitive, in that it's more competitive to be able to construct a self-managed super fund, look after it on an annual basis, and also then go and invest the money in a way that's still quite diversified, but still very low cost. And so what Matt is sort of suggesting as an example, he's saying that you can go and set up a self-managed super fund and run all the annual admin and compliance, accounting, reporting, all that sort of stuff for $1,000 a year. And he mentions a provider, Stake SMSF, STAKE, SMSF, obviously a business. I don't know of them, so I'm not expressing a view. And then he said, well, you can use, Perla or Beta Shares Direct or really low cost online share broker to be able to then go away and invest in ETFs. As I understand it, you could use Beta Shares Direct brokerage for zero brokerage. So that's pretty cost effective, of course. And then he mentions, well, then I can go away and invest in DHHF, which is Diversified All Growth Beta Shares products, or GHHF, which includes the same product but with a little bit of gearing. And the idea, he's saying, well, then, even if the savings are marginal today, in the future, there's potential much greater benefit in terms of not only annual fee savings, but also then having the benefit of avoiding the capital gains tax when you roll over into pension phase. And so he's wondering if I have an opinion on that, where historically people have sort of said, well, you need $250,000 to $500,000 to justify a self-managed super fund. Is that different today, given the products are more competitive? I hope I've made that explanation of the question too long-winded, Matt. I hope I haven't butchered your question either. Look, it's a really good one. I guess the answer is yes and no to the question. Yes, because it's much cheaper now to run a very basic self-managed super fund. You could theoretically do that for a lower balance today than what you could do, say, 10 years ago. We have had some experience with these low-cost providers. There's this theory around products and services that they have three elements and you can only ever optimize two. So the three elements are cost, features, and service. And you've got to choose two of those three. So, if you're going to go to a low-cost provider, then you're going to take a haircut on either features or service. And certainly that's been our experience. We had a client where we actually wound up his self-managed super fund because he didn't really need it anymore, put him onto a platform that was actually going to be cheaper. And to do that wind-up process with that low-cost provider was a bit of a nightmare. It took a long time. So, there's a cost to everything, excuse the pun. So if you go to a private provider that's going to be really low cost, $1,000 a year, look, it could work fantastically well for many years. There's some point down the line, you're going to need either the features or the service. And so, just go in eyes wide open and knowing that's the case. The main problem that I would have with the approach, it's not terrible, but the main problem I would have with the approach is the idea that, and just for context, Matt and his partner are in their early 30s. So the idea that I would just go and invest in diversified ETF for 30 years and there I am, I don't need to worry about it. I mean, you could. I'm not saying it's an absolutely terrible idea, but I talk a lot in the podcast about traditional market cap indexing and the benefits of using a variety of different indexing strategies. Now, I think we're tilting far more to value than growth at the moment. Growth has had its day over the last, particularly 5 years, but even extending to 10 years. And mean reversion will kick in and value will have its day as well. One day growth will be cheap again, in which case then you go all traditional market cap indexing, it's fine. So I say yes because theoretically, yes, the costs are cheaper, so you can justify setting up a self-managed super fund. No, because I'm not sure that very low cost approach would be the best approach to employ over the next 30 years until you're 60. But I guess you could say, well, let's put it in a self-managed super fund now. And when our balances start to become more considerable, again, for context, Matt's super balance and his partner's about 350 combined. So I guess when the balances start to become more significant, then you can think about getting an advisor to construct a portfolio, an evidence-based low-cost portfolio, still utilizing a self-managed super fund. I think there's going to be a lot more competition in the space. I think product providers are going to try and get into it. I know BetaShares is sort of working on a super product. We know that Vanguard has their product, although it's a pooled product, so you still have that CGT issue when you transfer over to pension phase. But I think technology is going to help. And I think setting up and running your own self-managed super fund will, over the coming decades, become cheaper and easier to do as a general sort of direction. So, but great question there, Matt. And thanks for your fantastic feedback also. Okay, next great question is from Dean. Dean gives me some great feedback about the podcast. So thank you very much for that, Dean. Dean's question, again, I'm going to paraphrase rather than read it verbatim. Dean's question is about potentially taking profit on a ETF portfolio in order to then reduce debt. So selling the gains in order to the capital gains that a portfolio has made in order to reduce debt. Let me give you Dean's example. Dean and his wife have a $250,000 home loan. And then they've got a separate $46,000 investment loan that was used to buy ETFs that are invested 50% in Aussie, 50% international. And those ETFs are now worth $56,000. And so what I'm reading into is that the debt is 46, the ETF portfolio is now 56. So there's $10,000 of gains there, if you like. And Dean's question is, should I sell 10,000, take those gains, pay the CGT, then reduce my home loan by $10,000? And then potentially what Dean could do is then go and increase his investment loan by $10,000 and reinvest those monies again. And by doing that, I guess what he's doing is recycling that debt by selling off those capital gains, because then he's going to have a share portfolio with 56,000. It's worth 56,000. The debt will be 56,000 because he's increased his debt by 10,000, but his home loan debt will now be 240 instead of $250,000. And for pretty important context, Dean says his wife and his taxable income is about $100,000 each. I mean, it's a really great question, something to think about. Theoretically, if you're really focused on getting rid of your non-tax deductible debt, it sounds like a pretty good idea. Let's work through some numbers then. If Dean has $10,000 capital gains in his portfolio, which is kind of what his question's suggesting, and let's assume that Dean's held those investments for more than 12 months, so benefits from the capital gains tax discount. Dean and his spouse are on $100,000 a year, which means his marginal tax rate is 32%. So on those $10,000 worth of gains, he will pay about $1,600 worth of tax. That means that after selling the $10,000, paying $1,600 of tax, he's got $8,400 to put against his home loan to reduce his non-tax deductible debt. If he's paying around 6% on his home loan, that'll save him $500 a year in interest, non-tax deductible interest. So you've paid $1,600 today to save $500 a year approximately each year, subsequent year in home loan interest. So allowing for the time value of money, I worked out that it's going to take you 3 to 4 years for you to be better off as a result of doing that. And that's because you're on sort of medium tax rates, I guess. If you were able to avoid any capital gains tax, which is probably unlikely where you've got gearing, because you've got the gearing because you have some taxable income. But if you're able to avoid capital gains tax, it might be worthwhile. But I think in this situation, the payoff period is too long. And the whole idea around investing is to try and benefit from compounding capital growth. So that is, invest the money that you've got, try and earn as little income and as little capital gains as possible so that you're creating as fewer tax consequences. You've got the interest, which is going to give you a tax deduction, so you get a bit of negative gearing there as well. And then you hopefully compound over many years the returns without needing to pay tax each year. That's kind of the whole mathematical methodology around building wealth over longer periods of time. If you're going to pay tax every year, the tax man's going to take, 16%. In your situation, 16% of the gain each year, you got less to reinvest. So great thinking, Dean, but no, I think I would stick to the plan. I think I would let those gains compound in the investment. And also, the other thing I've been thinking about is, the other observation I should say is that your loan to income ratio is pretty conservative. $250,000 of debt, $100,000 each of income, so $200,000 of family income. It's not too bad. I don't think it's going to be a struggle to get rid of that debt. Okay, next question is from Angus from Perth. Angus writes, hope you're doing well. I'd like to express my gratitude for your continual podcast series. I've been a listener since 2020 and greatly benefited from both Investopoly and Rules of the Lending Game. In fact, I lent my copy of Investopoly to one of my mates last year, and I think he must have loved it so much he never returned it. Oh, God. Okay, good. Angus goes on to write, I have a slightly offbeat question. Could you recommend a few other finance books that provide a deeper dive into various finance topics, whether it be investing in the share market, property, perhaps historical financial trends, or even a practical advice on managing finances in a similar light to that of Investopoly? I trust your expertise to point me in the right direction and many other listeners towards some great reads. It's a really good question, Angus. So, I had to think about it for a little bit. I mean, as you can imagine, I've read lots of books over the journey. Actually, I try to not read too much other content. I mean, I read a lot of technical content, particularly around share investing and so forth, but it's a bit funny. I try to avoid most of my peers' content because I don't want it to even unconsciously influence what I write about and what I talk about. So I mentioned that to a few people and they think it's a bit strange. And look, I might be a bit strange, but I want to try and make sure that I bring to this podcast some unique thought. And I just thought I'd mention that. Some ones that really have stood out over the last 20 odd years. The first one is A Random Walk Down Wall Street by Burton Melke. Look, he's one of the founders of Vanguard, or one of the early people that worked at Vanguard earlier on. And it's really around the randomness of returns, building a portfolio, asset allocation. It can be a bit heavy in parts, but if you want to learn more about the share market, that's a great one. Morgan Housel's Psychology of Money. I mean, I like probably most of the stuff that Morgan produces, and he's one of the few podcasts I listen to, not regularly, but spasmodically, and I really enjoy his work. And so Psychology of Money is a really good book. It's mainly, as the title suggests, it's really about how we think and approach money, but it's a really important aspect. And I couldn't leave out The Intelligent Investor by Benjamin Graham, one of the teachers of Warren Buffett. It's really around the fundamentals. It's probably I'm certainly not going to compare Investopoly to the Intelligent Investor. I'm not even getting close to making that comparison. But in terms of fundamentals that never go out of date, that book is a really good example of that. And it stood the test of time. It was first published back in 1949, so a long time ago, but still a very good book. They're the three that I would recommend. About 25 years ago, I read the book Streets Ahead by Monique and Richard Wakelin. I still think it's one of the best property books that talk about property fundamentals and asset selection and investment grade property. Although it was written probably, I'm guessing now, 25, almost 30 years ago, I think it stood the test of time. So from a property perspective, it's a book I ask my staff to read when they come start working at Pro Solutions. So, that gives you a bit of a head start. At least there's 4 titles for you to get your head around. Anyway, I hope that is of use, Angus. I'm sure you'll love all of them. Okay, next question is from Sydney. And Sydney writes, I appreciate your tremendous podcast. Always learn something and or have something to ponder after each episode. That's good. I'm glad it's thought-provoking. My question relates to self-managed super fund, something I'm contemplating setting up in my mid-50s and investing in property. I know you, in a self-managed super fund, you cannot change the underlying land use. However, my reading of the ATO info is that you can do some things to the land and property. Can you go as far as subdividing the land that has an existing dwelling that would attract rent? Number 2, could you also put a building on that subdivided vacant lot or construct a secondary dwelling? Borrowings would be necessary to acquire the property of about 50% of what's required. Borrowing would also be necessary to complete any build on a vacant lot. I'd likely sell down the pre-existing house. I've listened to the podcast about co-investing with your self-managed super fund and wonder if low-level development is permissible. If so, how would that be optimally structured? A further question is, am I able to transfer an existing investment property in my name into a self-managed super fund without capital gains tax or stamp duty on the actual transfer? That'd be nice. Okay, so Sydney, the issue around using these or doing something with the property is the limited recourse borrowing arrangement. They're the rules that are around those sorts of arrangements. So if you wanted to do a subdivision and development and so forth inside a self-managed super fund without borrowings, that's quite possible. You would want to make sure there's some issues around running a business. So you want to make sure it doesn't look like a business, it's an investment. But when you start introducing a loan, it means that each individual asset needs to be held in a separate bear trust. And so when you subdivide property, you're taking one asset and turning it into 2 assets because now it's on 2 titles. That would then have to be separated into 2 different bear trusts. So without going into significant detail, of course, nothing in this episode or in fact this whole podcast is specific advice. But I would say if you wanted to subdivide and then that's all you wanted to do, you could probably do that. You would move the titles into 2 separate bear trusts and you would then need to deal with the lender associated with that. So you might have 2 different loans. And so I think off the top of my head, that's probably doable. But when it comes to constructing, the issue then is I'm borrowing to buy additional assets. Each individual asset needs to have a separate bear trust, so that can create a lot of problems. Really, buying property in a self-managed super fund, you've got to be really careful. I wouldn't buy anything that I was going to make any significant changes to. And the only time I would do that, or the only time I would do that is if I could foresee that I would be able to get rid of the loan. So for example, if you thought, well, I'm going to buy this asset and maybe in 10 years time, I might do some development or whatever, but I'm going to have enough monies to be able to get rid of the loan, repay the loan and have no debt in the self-managed super fund by the time that I might contemplate doing that. And look, I've got a property in a self-managed super fund with a loan against it, and I might do something with that property in 10-ish or so years' time, but I'll just repay the loan and then have that flexibility to do something with that property, whether it's whatever that looks like, right? So you need to make sure that you're buying the right asset for the right ownership structure And I wouldn't buy anything that required that sort of mucking around with. What you could do, since you're in your mid-50s, you could say, okay, I'll buy this property. I'm of the mind to maybe do something in 5 to 10 years' time, where you could take it out of the super fund at that time and then do the development and then sell it. So, of course, once you reach your preservation age, which if you stop working at 60, if you're still working at 65, you can take that property out as a benefit payment. If you're in pension phase by that stage, I suggest you should be. You're not going to pay any capital gains tax if you're under the transfer balance cap, and you're not going to pay any stamp duty on that transfer. But once that property then is in your personal name, you can do what you want with it, right? Which means that you can do the development, subdivision, all those sorts of things. Or alternatively, just don't do it inside the self-managed super fund, or buy something that's more set and forget. In regards to the second question, can you transfer or sell an existing residential property to a self-managed super fund? Answer is absolutely not. There's only one exception to that if it's considered business real property, which is really commercial property, but the term is business real property. There's an exemption for that. So if I have a commercial property that, for example, I operate my business from, I can sell part or all of that into my self-managed super fund, but certainly not a residential property. And even if you could, you're going to have to pay capital gains tax and stamp duty. You can't, but even if you could, you would anyway. So anyway, good questions there, Sydney. A bit technical, but thanks very much for your feedback firstly, and then time to submit that question. Okay, next one is from Stefan. Stefan writes, not a question, but a thank you. Hello, Stuart. Big fan of you for a long time. I know you don't give financial advice on your podcast, but it definitely gets my brain ticking on avenues to research further, which is great to hear. On your recent Q&A episode on Monday, you answered a question. This would be Monday from a long time ago. You answered a question from Sam from Perth in WA. We find ourselves in a very similar situation to his. We have a fully offset home loan in an investment grade location in Melbourne, and honestly have been thinking about renovating it to make our dream home for a very long time indeed. Your answer to Sam, especially how you outlined how you're going to renovate it in terms of doing it properly, not a weird half-half approach. And even if you overcapitalize but live in the property for a long time, it really won't affect your overall strategy, was honestly so comforting for me and my wife to give us the confidence to proceed and make our idea a reality. Thank you for helping average Joe guys like me out there and not just the extremely wealthy. Really, thank you so much for your feedback, Stefan. You know, as a business, I firmly believe in the philosophy that if you're running a business, if you want to help everyone, in fact, the way Seth Godin, which I follow, certainly his blog, Seth Godin puts it, as soon as you want everyone, you want no one. So it's really important to be able to cut through and create a sustainable business, to have a really focused and discipline-focused niche that you want to work with. What are the types of clients that make the best types of clients for my firm? That means that you have to say no to a lot of people, which really grates on me. I constantly wrestle with it because I would like to actually help everyone possibly. But the reality is to, build a great business, to attract great team members to that business, for a whole host of different reasons. It's not just about money or profit. That's not really the best approach. So instead, what I hope to achieve is that the podcast and blog helps a lot more people at this level than what we could help on a one-on-one basis. And, whilst I can't help everyone in my business, at least people can continue to listen to the podcast and so forth and get help that way. So your feedback, Stefan, means a lot to me. And I'm glad that you and perhaps other listeners also get some benefit out of these podcasts. And I do apologize, if you do make contact with Pro Solution and we say, look, we don't think there's enough scope for us to add value, I do apologize that's not meant to be rude or to offend you. It's really just about making sure that we have really enough complexity in our client base to, stretch and reward the staff and the team that we have within the business. Okay, next one is from Jeff, and I think it's going to be, I think a lot of listeners are going to relate to this question. So Jeff writes, thanks very much for the podcast. I've been listening for a number of years now and have been particularly enjoying the case studies and Q&A episodes. Thanks, Jeff. As I said previously, I enjoy actually answering them. So my wife and I live in Melbourne. We have two kids, 3 and 5, and are thinking ahead on how to get our finances back on track once both kids start school. Jeff's 40 years old, earns 130,000. Jeff's wife is 38 years old, earns 115,000. They have about 35,000 of shares in ETFs, about 450 in super in an industry fund, and their home is a villa unit worth 850 with $568,000 mortgage. We're very much looking forward to 2 years' time when we no longer need to pay childcare fees and can focus more on our financial goals. Childcare fees are insane. I mean, people talk about private school fees, but childcare fees can be sometimes more than private school fees. And I've spoken before about the difficulty of really building wealth in that time when you're building a young family, when, both spouses are working full time necessarily and expenses are higher. So I empathise with your situation, Jeff. Anyway, Jeff goes on to write, would like the option to switch to part-time work in about 20 years, so it's about 60, and retire completely at 65. Retirement to us includes travel, paid off home, and potentially helping our kids get into the property market. In the short term, we'd like to upgrade our family home to our forever home, looking at spending about 1.4. So remember, the current home's about $850, so that's another $550,000. Given our goals, time horizon, and income, I'm interested in hearing your thoughts on taking on that amount of debt. Can you suggest some strategies for people in a position like us that can accelerate the repayment of debt and improve our financial position? I'm keen to explore increasing our asset base as well as in terms of making additional investments. At what point in time could you see it being too late to buy an investment property leading into retirement? Thanks, Jeff. Okay, so it's a really good question, Jeff, because I think, a lot of people sort of face a very similar situation. So you want to do the home upgrade as soon as possible because, of course, we need to pay for our home using after-tax dollars, after-tax savings, whether that's through initial deposit or eventually repaying a home loan. And that's a very expensive way to buy an asset. So the longer you delay it, the more it's going to cost you on an after-tax basis and the more it impedes your ability to go and build wealth. I hope this doesn't come across the wrong way, but borrowing to the level that gives you indigestion is typically actually a good strategy. Now, I'm not talking about being absolutely stupid and not having consideration to affordability and those sorts of things. But thinking back 20 years ago, every time I went and upgraded my home and bought another property and took on a loan that I considered to be, significant, something that gave me a bit of indigestion, I look back on that and go, that was a really good decision. It's a great forced savings mechanism, if nothing else. You've got then a very strong focus on an incentive to manage cash flow well, to reduce debt as much as you can. And ultimately, by upgrading, you're typically buying a better quality asset as well. So naturally, the value of that asset appreciates over time as well. So, look, I think you've got to really look. Sometimes there's clients that you got to talk them down. They're being too aggressive and they're being silly and they haven't considered all the risks. But I think that there's a greater cohort of clients that you've really got to push them a little bit and say, look, you're young, you've got good incomes, you're in good industries, you've got good job security, and certainly that's true for most people in Australia, and particularly now. Just push yourself a little bit harder. And so that's the first thing is, if you're trying to get your head around borrowing an extra 550,000, which would take your debt to about 1.1 million. I haven't done the numbers to make sure that's doable. And you would need to do that, of course. I can share my own personal view that where I've pushed clients and when I pushed myself previously, I've always looked back and gone, yeah, that's a good idea. In terms of accelerated debt repayment, I did a blog Actually, it was episode 290 back in February 2024, and it's called Accelerated Home Loan Repayment. There's only 4 ways. I wrote that episode. I did that episode because I kept getting annoyed reading all these different articles about how you can repay your home loan sooner. The reality is there's only like a handful. Obviously, reduce your interest rate as much as possible. Make sure you put as much cash into the loan as possible. And really, that's it. I mean, if you're self-employed, there might be a different strategy and, you've got to have a plan B, which I'm going to get to in a second. But really, it's just about minimizing the interest rate and then putting as much cash into the home loan as possible, as soon as possible. And there's no magic bullet there. That's all you can really do. The thing that I would say is that if you go out and borrow 1.1 million of non-tax deductible debt, that's a big loan in anyone's numbers. I'm not certainly seeking to diminish that. But as I said, it's a great forced savings mechanism. In 10 years' time, inflation will eat away at the balance anyway, and you'll look back and go, actually, it wasn't that big a loan. It's funny how with the fullness of time, these things happen. Again, I just want to repeat, I'm not being or promoting people to be foolish and not making an educated decision about how much they're borrowing. I'm just saying that there's, sometimes you need to sort of push yourself. And really, if I look back in my life and think about 20 years ago, I actually wish I did push myself a little bit harder. It would have worked out fine. And the way I look at it is look, if it doesn't work out fine, I'll sell the property in 2 or 3 years' time. As long as I bought well, I probably won't lose any money. Nothing ventured, nothing gained. So anyway, in terms of, then how do you've got a really big home loan, what do you do then? Well, it sounds a bit counterintuitive, but really the answer to being heavily indebted is to get more debt. I know that sounds a bit silly, but when I have a client with a really large home loan, of course, what we want to do, and Jeff, what you've said is your goal is to not have a home loan in retirement. Of course, that makes sense. Then I want to have a multi-pronged approach in order to repay debt. Now, plan A might be use cash flow, and that's fine, but you want to have a plan B. And so the plan B could be go and buy an investment property and then sell it, just after you retire to repay debt, or at least repay any residual debt that your cash flow hasn't allowed you to repay. Now, of course, if you go off in a couple of years' time and go and borrow 1.1, you might find you've maxed out your borrowing capacity. But, a little bit down the track and as soon as possible, I would certainly, and if it's, in line with your risk profile and appetite and cash flow and all those sorts of things that you need to think about, if you're then open to gearing to go and borrow to buy an investment property, I would absolutely do that. And I think it would be even more important because you have such high debt. So the strategy, go and upgrade your home, sort of borrow to your eyeballs to some extent. Great forced savings mechanism, will maximize your wealth on an after-tax basis because obviously the capital growth in the family home is going to be tax-free. Go and buy an investment property that's going to give you a little bit of tax relief, but then at least you've got something to sell in 20 years' time if you haven't been able to repay your home. And then obviously over that next 20 years, you'll be making super contributions. So you want to make sure that really works well. And, there might be some abilities to make additional super contributions or continue to invest in the share market, maybe not in the next 10 years, but, maybe in your 50s or something like that. That's the general sort of approach, Jeff, that I'd be thinking about in your situation and all the Jeffs out there. So hopefully that gives you a good sense of some of the things that I'd be thinking about. Again, this is not advice, just a little bit of commentary. Thanks again for all the amazing questions. They're all really thought-provoking and good. As I said, I really enjoy answering them. I might leave it there. We have Campbell joining you tomorrow. He's got a really great episode about rent vesting, and he's produced numbers, of course. We're evidence-based. Everyone in our firm's evidence-based. And he's produced his own analysis around rent vesting versus owning your own home. It's a really interesting episode. Hope you check that out tomorrow. Otherwise, I'll leave it there. Cheers. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.